This tracks the price of a single industrial metal across late 2025, a 95% surge, peaking over $307,000 per kilogram. Overlaying global inventory on the same timeline is stark. While price skyrocketed, physical supply dropped off a cliff, hitting a 40-year low. Normally, a price spike of this magnitude triggers a global rush to find more. Higher value usually incentivizes companies to expand production and bring more raw material to market. But rhodium refuses to follow that rule. Even with the global market desperate for volume, supply remains totally unresponsive to its record-breaking demand. This creates a unique bottleneck for the global automotive industry. As long as internal combustion engines remain on the road, manufacturers are tethered to a supply chain funneling through a single geographic point. Global rhodium production is incredibly concentrated, yielding only about 25 tons a year. 85% of that output is extracted from a single region, South Africa's Bushveld Complex. These operations are dominated by three major mining groups: Impala Platinum, Sibanye-Stillwater, and Amplats. Together, they underpin the world's primary supply of the metal. However, none of these companies operate a dedicated rhodium mine. In fact, no such facility exists anywhere on Earth. This 2024 Sibanye-Stillwater ore split reveals a difficult reality. Platinum makes up 59%, while rhodium is restricted to a tiny 9% sliver. This is the byproduct trap. To get more rhodium, companies must overmine platinum and palladium, regardless of market demand. Because of this geological constraint, rhodium supply is extremely inelastic. Production levels cannot adjust to spikes, locking buyers into a cycle of permanently limited supply. The automotive sector is the primary driver of this demand, consuming over 80% of all mined rhodium for use in catalytic converters. Stringent emission standards in Europe, China, and India have created a paradox. To meet these rules, automakers must actually increase the load of rhodium in every internal combustion engine. Secondary supply from recycling does little to ease the pressure, as it only returns approximately 10 tons a year to a market requiring much higher volume. The fragility of this arrangement was demonstrated in early 2025 when a localized weather event in South Africa triggered a global supply shock. Flooding forced Amplats to halt operations at its Tumela mine, a facility responsible for 10% of the group's total output. With production stalled, Amplats had to buy rhodium on the spot market to meet its commitments. This move instantly drained the already record-low global inventories. Because the buffer of above-ground stocks has been reduced to just 4 months of demand, a single flood in South Africa now has the power to threaten global automotive manufacturing. The industry is attempting to expand, with over $1 billion in capital currently committed to projects like Ivanhoe's Platreef mine and Tharisa's underground expansion. This timeline shows the scale of the challenge. While the market is in a deficit today, the long cycles of deep-level mining mean that new capacity won't impact the market until the mid-2030s. The primary variable that could shift this dynamic is the transition to electric vehicles, which eliminate the need for rhodium catalysts entirely. But as long as hybrid and traditional vehicles remain in production, strict emissions regulations make the use of rhodium non-negotiable for manufacturers. If mining regions face further disruption while demand remains high, analysts project prices could reach or exceed the $12,000 per ounce threshold. South Africa's dominance of the rhodium market is an immovable geological fact. For the global industrial complex, this concentration creates a permanent vulnerability that cannot be ignored.